Hey everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT, the DXY, the yen, and a little extra bonus at the end. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So again, it's been a while actually. July is probably my busiest month of the year. I'm usually away for 5 days, so it's kind of difficult to make videos. But again, as I said in previous videos as well, I'll do my best to make as many videos as I can during the week. It's something I love doing, so I'll do as many as I possibly can, even if that means just making one. All right, one per week. So let's jump right into things here. The best place to start is TLT. All right, we've seen a rejection play out on the bear market resistance band. Again, bull market support band. At this point, it's better calling it a bear market resistance band, as we still, every time we get up near it, we seem to get rejected off of it. And again, the rejection came because of the non-farm payroll report. Now, I personally didn't give a forecast on the NFP number simply because of what we read in the PMI report in 23rd of June, where particularly this section here about employment, companies talk on additional staff at a rate not seen for over a year, largely in response to the need to meet higher workloads. And again, these higher workloads, according to the PMI report, in other parts of the report, were due to tariff front running. Again, that to me didn't really sound like, didn't really make much sense. All right, because again, tariff front running, if you do the front running before the tariffs, you don't do it during the tariffs. Okay, so that to me didn't really sound to, didn't make much sense. But regardless, I didn't fade the PMI report, and I just said, you know what, I'll set this one out. And, I kind of sniffed out a weird number, and we got 146, 149 if I'm not mistaken. What I did do is give you a forecast for the unemployment rate, no, just for laughs and giggles here. I forecasted a rise to 4.3, if not 4.4, because of everything that we spoke about, the initial jobless claims, continuing claims, which we got another round of today. But we saw the exact opposite. We saw a decline to 4.1, right? Now, the main culprit behind this decline is the labor force participation rate, all right? Now, there are a few things that can play into this, all right? Last year, for example, I remember we were on the uptrend, okay? We're still hovering around, 62.7 more or less. And we still had the taps wide open on immigration, all right? Now, one of the theories and rationalizations behind that increase that we saw last summer in unemployment was that probably the economy, it wasn't, running on all cylinders. And given the degree of immigration that we had, people coming in simply weren't finding jobs. So again, labor force participation rate goes up. Economy not firing on all cylinders, by all means not in a depression or a recession, but again, definitely not as hot as a couple of years before. You get a rising unemployment rate, all right? Now, you could argue that we are on the opposite side of the spectrum this time around because the spigots on immigration have, somewhat turned off. So you really don't have that upward pressure to the labor force participation, right? Meaning that you really have the unemployment rate potentially moving lower, all right? That's something to consider. But what you also have to consider is that might be one of the reasons why. Another reason why we might be seeing the labor force participation rate moving lower is simply because people are just probably giving up to a certain degree, okay? And this is potentially where you can see this in the continuing claims, all right? It's tough to find a job. It's tough, All right. We are well above pre-pandemic levels. All right. We are at 2017 levels now. After today's read, we're at 1.97 million. Okay. So it's important to keep an open mind, but I would keep every option and scenario open, especially the weakening labor market, in my opinion. Okay. So yeah, really, there are a lot of things that could be playing into this. I still wouldn't discount. I wouldn't call the all clear. All right. The unemployment rate moving down because the labor force participation rate is coming down because people are finding it hard to find a job is an unemployment rate moving down for the wrong reasons, if you will. Okay, so it might look fancy in the short term, but again, it doesn't really reserve anything pretty in the medium and longer term. Okay, so that's really it for the unemployment rate. Now for the NFP number, there are a few things that we can say. Okay, now 147 is the number that we got. Okay, now about half of it was about what came from state and local governments. All right, private payrolls totaled about 80K, something like that, and that's the first thing to consider. Right, private payrolls definitely aren't as far away as the headline number from the ADP number that we saw on Wednesday. Okay, so that's the first thing to remember. Second thing to remember is that this is just the first print. All right, the first print in March was 228. The third print was 120. The first print in January was 143. The third print was 111. By the time we have the third revision is, an average of, when compared to the first revision, that is, or rather the first release rather, but an average of 35 40K. This is probably around that ballpark. So if you kind of shed, let's say 40K off the initial number that we get, we're already down to 100K. All right, and this isn't even counting the QCW revisions that we get, every two quarters later. And we know that the QCW revisions that we get usually, in 2024 rather, have trimmed about 50 to 60,000 jobs per month. All right, so if you go from 100K to about 40 to 50K, and you still have state and local government jobs in that number, in that final 40 to 50K, where does that leave private payrolls? Well, it leaves it not somewhere that isn't too dissimilar from the ADP number. All right. Now, again, this might sound like coping, and I know that I'll definitely I know that probably sounds like it, but this honestly is the exact same stuff I've been pointing out so far. All right, each number that we've been getting is overstated by quite a bit, and even the final read that we get, the third and final revision that we get, is still overstated given what we see in the QCW releases 2 quarters ahead. So when everything is said and done, you really don't want to have the first print come in lower than 100K, because you already know that more or less you're going to have revisions of about 30 to 40K, which puts you between 60 and 70K, and you already know that the QCW is going to come and shellac you by another 50K. So any number below 100K is really just saying, yeah, we're negative on the non-farm payroll number. All right, and I know it sounds, again, hard to believe, but if you look at the hardest of data, those are the numbers. Those are the figures that we have to look at. All right. So do consider this as well. All right. 147K. We did get an initial revision up, right, which was a nice change. A nice change. Went from 139 in May to 144. Congratulations. But as far as I'm concerned, this doesn't really change much. All right. Even in 2024, we did see August, for example, get revised up in the first release, only to get shellacked again by 81K and then 64K. All right. So, or even here, what is this? December of 2023. All right. We went up, then down and down, down, and then we got revised up. Okay. So this 5K revision to the upside doesn't really change anything in my outlook. Again, it's still the same of what we've been seeing so far. All right. For any news, we'll just have to wait for new data to come out. So again, just to summarize on TLT, I know this number might sound grandiose and okay and good, and the labor market is solid, but as time goes by, it doesn't really leave. It just gets revised away, right? To put it simple. So do keep that in mind again. And as far as TLT is concerned, yes, anything that is a beat on the headline number will be regarded as bad news for bonds. All right. And as long as we're in this environment where we don't have any smoking gun, the bond market will likely continue to play around with this stagflation theme. All right, we've been really range bound ever since April, between 84 and 88.50. Don't think that any move lower to about $80 is impossible. But don't make that your base case. Just keep an open mind for this. We do have some data next week that could, push us in either direction. We have CPI coming out next week. So, again, CPI comes in good. That's constructive for bonds. If it comes in bad, less good for bonds, of course. As far as I'm concerned, though, the economic backdrop hasn't really changed. All right, to put it mildly, this non-farm payroll report, at the end of the day, again, given all the revisions, and we'll know in 6 months' time what the real number is. It'll probably be closer to 50K, 50 to 60K, somewhere in that range. Okay, so has anything changed? Again, no. Okay, to put it mildly, no, nothing's changed. And again, I continue to reiterate my outlook that if you're here waiting for the smoking gun, the spike, the sudden change the sudden change, you're probably gonna get disappointed. All right, this is something I've been saying ever since April. It's most likely going to be a process. We're gonna get there eventually, but it'll take some time. All right. So patience is the name of the game here in Treasury land. So really, that does it for TLT. Now, I want to briefly touch on the DXY and tie it back to TLT as well. So far this cycle, the moves in the DXY have been pretty straightforward when connecting them to rates, because again, rates move up, the dollar moves up. Rates move lower, the dollar moves lower. All right, and we've seen this, again throughout this cycle. July of 2023, rates have to start moving up, the dollar moves up. Then in last summer we have that growth scare, dollar moves lower, rates move lower. Then growth kind of surprises to the upside, and we have the dollar moving up and rates moving up. Pretty straightforward. Ever since January, we have rates moving lower, the DXY moving lower. that is until April. In April, we saw something kind of weird happen. We saw the dollar moving lower and rates moving higher. All right. Right here. Ever since the week of April 7th, we've seen rates move up and the dollar move lower. And this has spooked quite a lot of people because it was kind of like this sell America trade, if you will. Sell America. The dollar is doomed. Bonds are doomed. It's all doomed. It's the doomsdayers were having a picnic back in April. But I really took that time to ask myself the question: have we ever seen such a thing happen, or are we really living through unprecedented times, if you will? And the answer is, of course, yes. We have seen this kind of price action before, and you can see it here highlighted between the yellow bars. The yellow bars indicate a period of time where the dollar was moving lower and it was accompanied by rates, for example, in the 30-year bond moving up. All right, so in January of 2008, we went from 76 to 72. And again, I'm being generous here with the measurements. So let's just say 5.5. A decline of 5%, 5.5% on the dollar index. At the same time, in 2008, from January to June, 30-year bond went up by about 63%. 63 basis points. Okay? The same thing happened during the collapse of Lehman Brothers. Probably one of the worst times in financial history. Okay, we go from about 78 to 75.9, a 4% decline, right, give or take. At the same time, during the collapse of Bear Stearns, we go up by about 40 basis points. All right. The same thing happened in the 1990s. If we take our time machine and go way, way back, from the end of July of 89 to September of 1990, we declined about 12.5%. And the 30-year bond went up by quite a bit, by about 137 basis points. All right, pretty sweet, huh? Now, why is this significant? Well, it's significant because of what follows after and what you see in the green bars. What you see in the green bars are periods of time during which the dollar goes up and yields go down, right? Funnily enough, because again, why does this all sound so weird? Because again, the idea is if a currency's interest rates are moving up, ideally that would make that currency more desirable, right? Because you're getting extra yield by buying into that currency, and if yields are coming down, well, that makes that currency less desirable because again you're just getting paid less. All right, so it's counterintuitive, if you will. So moving on from 1990 to about 1991, about a year later, half a year later, the dollar rallied about 16.5%. During the exact same time, again, I'm being generous here with the measurements. I could measure from here. Let's just measure here. We went down by about 40 basis points on the 30-year bond. All right, which is probably more, again, if you measure from peak to bottom. But again, I'm trying to be as conservative as possible in the measurements. And again, the same thing is true for what happened in 2008. Okay, in 2008, after the first 6 months of the year, we had Bear Stearns right here and Lehman Brothers right here. After the collapse of Bear Stearns, we went from basically, what was this, 4.7 to about 4% on the 30-year bond, a 70 basis point decline on the 30-year bond. During which, again, the DXY, lo and behold, went up by a nice 8.5%, let's call it, okay? And again, if you look at what happened after Lehman Brothers, we go from 77, give or take, to about 88, at 14% increase in the DXY. And again, this is kind of, every TLT's, TLT holder's, dream, if you will. We go from 4.4 to 2.5, about 200 basis point decline on the 30-year yield, okay? Now, is this, as I said back in April, I'll say it now, am I saying that this trade will play out right now, next week, in an hour? No. But if you look at history, and again, if you look at 1990, for example, that trade where you saw the dollar move lower and rates move higher lasted, about a year. All right. Okay, this can go on for quite a while. But what is significant is that what happens on the other side of it. All right, what happens on the other side of it is a dollar that is rallying and rates that are coming down. Just like in 2008, what happens when the dollar is going down and rates are going up is followed by the exact opposite. The dollar going up and rates going lower. Now, if we look at today, I'm still treating this as a bull flag. And again, we could easily just puke below it and call it a day. Now, I gave you this level right here, if you will, of 96.1, and we kind of really got close to it, all right? We got really close to it. We closed at about 96.3, and we're more or less there, all right? I'm going to give myself a pat on the back for the time being, all right? For the time being, because I'm going to just easily puke down below and invalidate the whole thing. But again, why 96.1? Well, if just look at the 2010s, right? The second half of the 2010s, it was often support and resistance, all right? In 2015, it acted as support and resistance, right? Same thing as 2016. It acted as resistance in 2018, as support in 2019, up until July of 2020. And in November 21, it acted as resistance, potentially now playing out again as support. All right, potentially. All right, this small little green candle is, giving a lot of dollar bulls hope. But we're starting to see a bounce, and I'm also starting to see a lot of people, starting to bull post about the dollar. I would just keep in mind what I just went over now. Could we see something totally out of left field, where the dollar moves up and rates move lower? That would not surprise me in the least. Given the context of history, given what history shows us, when we see this kind of, weird trade play out where the dollar is declining and rates are moving up, what follows that is the exact opposite. You see the dollar moving up by quite a bit and rates moving lower. All right. And as long as this kind of bull flag is intact, that is my personal bias. So I'm, again, bullish treasuries, I'm bullish the dollar. I'm also kind of bullish the yen. Now, why am I bullish the yen? Well, I really can't help but not compare this to the move that I saw back in 2022 in Bitcoin. All right. with Bitcoin, again, it's slightly different because, again, we didn't really see the yen kind of sweep the previous high as we did in Bitcoin in 21. But regardless, when comparing the two moves, we have decline, price moving lower. Then we have kind of bounce up to the bull market support band, try to hold resistance. We're kind of starting to, give some credit to this upward trending, the trend line right here. And then we puke through it. And if you look at it right here, it doesn't look too dissimilar. Again, we had a strengthening in the yen. Okay, so down move in the dollar, price action moving lower. Then we plow through the bull market support band, try to hold support. We bounce again, and then we puke through it. What happened after that was essentially a bear flag. All right, we slowly trended up higher, and it was kind of like in the in the Simpsons when Homer and Bart are really roasting that the huge succulent pig, and then Lisa comes and just throws it, makes it fly across Springfield, and Homer just keeps saying, "Oh, it's just a little airborne. It's still good," and eventually just say it's ruined. It was kind of the same vibe that I got from Bitcoin, because it was like everything's fine, everything's under control, higher lows, higher highs, everything's great. But in essence, this was a bear flag, and potentially we're seeing similar price action in the yen. All right, a decline followed by, yes, higher lows, some degree of higher highs. Yes, absolutely. But we're kind of bear flagging, is my point. All right, so that's kind of my bias in the yen. And again, I can hear you say, but if you're bullish the dollar, why are you bullish the yen? I mean, what's going on? Being bullish on the DXY is really more telling, if you will, of where you think that the euro is going rather than the yen, simply because the yen in the DXY has a weighting of about 15%, if I'm not mistaken, while the euro is weighted to about a weighing of 45%, 40%, something like that. So if you're saying that the DXY is going to go up, what you're really saying is that the euro is going to go down. All right. So the euro has had quite a tear. We've got close to this trend line right here. Again, we could easily just plow through it, all right, and call it a day. But again, given history, I'm still of the idea that I'm still a dollar bull, if you will. I'm definitely not a fan of fiat and all that. I definitely see the appeal of gold and Bitcoin, absolutely. But I think that we've kind of overdone it a bit on the the dollar doomsday, and the dollar is going to collapse, the dollar this, the dollar that. I think it's yeah, the doomsday has had their picnic, but I definitely don't think it's time to crack out the canned tuna and then go hide in a bunker just yet. All right, so that's my my view on the DXY and the yen. And again, that ties back to TLT again, as I was saying in the 30-year bond. When looking at the moves on the dollar, whenever you see rates moving up in the face of a lower dollar, what comes after that is usually lower rates and a higher dollar. All right, as weird as that sounds, but that's what history shows us. All right, don't shoot the messenger. So that really does it for the end of the video. The last kind of bonus that I wanted to talk about is, let's see if I still have it right here. No, I really wanted to, I don't have it, but regardless, I'll make another video about that. So that's one, here it is. I kind of forgot about that. Trueflation, this is something else. It's kind of a reminder for everybody that the data will come in a non-linear fashion. All right, we'll have data will come up, data will go down. But what's important is really try not to fall prey of picking and choosing your your data sets. All right, I try my best to stick to my guns when when it comes down to choosing what to follow and what not to follow, what I always preach is don't skip, from one thing to the other just because it's saying something that you might like or might not like, right? Like the PMIs, for example. The PMIs last month was saying something kind of weird, and something that was kind of bullish, all right? That I disregarded altogether? No, I gave it credit. And in fact, even if it was for laughs and giggles, I didn't give a forecast because I've decided to trust the PMIs. They're fairly useful in my opinion. And why do I have Trueflation up? Well, the latest read of Trueflation is 1.6%, all right, 1.68, which puts us right here, right where we were, if you will, the reading of May 9th, all right, just coming off of this decline in early March. And the reason why I'm showing you this is because Trueflation is one of those anecdotal reads on inflation that gets used in turn by deflationistas and inflationistas. Last year, Trueflation was declining, and deflationistas were, it was the best thing since sliced bread. Every deflationista on X was talking about how great Trueflation was. And every inflationista was saying, yeah, but it's overstated. It can't be that low. Yeah, we know CPI is kind of, full of crap and everything, but yeah, it doesn't really matter. Then this year, right, from April, Trueflation goes from 1.2 to about 2%, 2.10%. And every inflationista, well, not every inflationista, I'm getting a bit of allow me to be a little over dramatic here, but every inflationista has been pointing towards Trueflation, saying, yes, this is the inflation that we've been looking for. This is, this is the truth, Trueflation. This is what we should be looking at, all right. And for deflationistas, Trueflation has kind of gone off the radar so far. Now I kind of see it coming back, for round trip, if you will, as the read on inflation by Trueflation has been coming down. The latest read is at 1.68%. 1.68%, meaning that it's the favorite read for deflationistas. All right, try not to fall in this trap where you're really chasing data. This guy reinforces my bias, so now I'm listening to this guy. Or wait, then he changes his idea. I'm gonna go to that guy over there. The reason why I have a lot of people linked in my bio is precisely because of that. There are bears. There are people that are definitely more bullish. I can point out two right on the top of my head. I have Capital Flows on X. He's definitely bullish. I have Daniel Di Martino Booth. Definitely bearish. I have Neil Dutta. He's been a bull ever since last year, up until last year, rather. Now he's kind of more on the bearish side. Who else do I have? A lot of people. I have George Gaiman, whatever. There are a lot of people on really across the spectrum. I try to listen to as many people as possible, to even opinions that don't go necessarily in my favor. All right. If you kind of box yourself in and try to hop around to find kind of this is the guy that's telling the truth, you're probably gonna get disappointed. You're probably better off just finding your own your preferred sources. Get comfortable with them and use them to come to kind of your outlook on things. All right, that's generally speaking how my trip has been going in the investment space. So again, that's kind of my warning, my final my final warning, if you will, to close the video. And again, I'll leave it at that. Again, I'll do my best to make as many videos as possible during the week, even if that means making one video only. Okay. So it was nice to be back at the screen. If you like this kind of content, consider leaving a like, subscribe, and I'll see you next time. Bye bye.